I'm Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up, $120 billion wiped off Facebook's market cap in the blink of an eye after earnings disappoint. This is the largest single loss for a single company in history. What's got investors nervous ahead? Plus, how the rest of tech fared in earnings this week and the ripple effects felt through the market after Facebook. We'll dig into Amazon and Alphabet's quarters as well. And President Trump's fight with China chills tech deals with the death of the Qualcomm NXP merger. What to expect from tech M&A ahead. Well, Facebook's market cap wipeout this week was the biggest in U.S. history. In the blink of an eye, about $120 billion was wiped off Facebook's valuation. That's two-thirds the size of 1929's Black Tuesday market loss and larger than Texas Instruments, Broadcom, and Salesforce. This all followed Facebook's earnings disappointment on Wednesday, when, for the first time since 2015, the tech giant missed analyst estimates on revenue. Facebook also missed on both monthly and daily active users. Daily active users remained the same in the United States, 185 million, and declined in Europe from 282 million to 279. We spoke with Techonomy CEO and our Bloomberg contributing editor, David Kirkpatrick, as well as Melissa Parrish of Forrester Research right after the results were announced.
Facebook has missed for the first time in quite some time. Although I would say that in my world, an 11% year-over-year increase for active users, both daily and monthly, is still a win. So the headline is perhaps a little different than my own interpretation of the numbers.
And look, David, they missed on all of these metrics, but not by a lot. Are investors overreacting?
Well, it is a historic day because I think it's a sign of a turn, but I would also agree with Melissa. Revenue is up 42% year over year. This company is not hurting, but they did disappoint vis-a-vis expectations, and that in itself is historic. And I think actually probably it's healthy for the company to see their results get criticized, because it'll force them to take these problems they're in the midst of even more seriously and perhaps be more candid with how they're addressing them, because I don't think they've been very candid, although some of the results suggest they're spending even more than we thought trying to remediate it, which is good.
Now, we've got some great commentary happening right now on Bloomberg's Top Live blog. My colleague Shira Ovide asking the perennial question, has Facebook reached the end of new users? Are there just no more new users for Facebook? Melissa, what do you think?
Well, I think that's a very fair question to ask. They are at 30% of the world's population. There will be a ceiling at some point. I don't think they're there quite yet, though, because though we know that sentiment and interest among the youngest users has not been as strong as for previous generations, I think there's still a lot of room for growth there. There are an awful lot of young people in the world who have yet to get on Facebook.
David, how much does this have to do, you think, with the scandals, with concerns over data privacy?
Well, it's funny because as you asked that last question to Melissa about growth being, no longer possible, which I think it occurred to me, look, there's still plenty of more people to come onto Facebook. But we know, for example, in India, people are flocking onto Facebook right now, so that if in fact growth is slowing globally, it could mean that even more people are coming off in some of the more developed countries or slowing their usage. And that could be significant because those are the users that are the most profitable for Facebook at the moment. But there is a massive underserved, still unserved community of people in the billions in the developing world that want Facebook, that will get Facebook. Growth has not ended for Facebook. But again, this is a historic shift. Things are not as good as they were, and that is significant.
That was Techonomy CEO David Kirkpatrick and Melissa Parrish of Forrester Research. I also caught up with Roger McNamee of Elevation Partners Thursday. With Facebook tumbling as much as 20%, McNamee was one of Mark Zuckerberg's mentors and an early Facebook investor, and has been very critical of the company's privacy issues. Take a listen.
Investors have been willing to overlook a lot of red flags that have been showing up for the past year. The maturity of North America has been in sight for the last 2 quarters. There were at least signals that Europe was reaching some kind of saturation as well. And those are by far the most profitable parts of the Facebook application in terms of generating profit. And so any slowdown there was going to spell trouble for the stock. And to be clear, I look at this thing as a mixed situation for Facebook. If you're an investor, the good news is that Facebook has other properties. It has Instagram, which is very profitable and growing exceptionally rapidly. It is, in many ways, just as bad a product for users as Facebook, and for teenage users, it's actually much worse. They have just begun to monetize WhatsApp, which is humongous, and they haven't done anything with things like their marketplace. So there's a lot of growth opportunity. The issue is, what PE multiple are investors going to put on that, given that Facebook's underlying business model is really based on promoting disinformation and hate speech and things like that, not because Facebook approves of disinformation or hate speech, but rather because those are the things that generate the most engagement, the most views of advertising, and therefore the most economic value.
Now, Mark Zuckerberg sort of pitched Instagram as the savior on the earnings call, but as you mentioned, it has some of its own problems. You've been very outspoken about the privacy issues. Do you see some of those same threats with Instagram, Messenger, and WhatsApp?
Well, with Instagram, the real challenge that is happening today comes in 2 places. One relates to the impact on teenagers. If you look at girls between, say, the ages of 12 and 15, there are huge issues of bullying relative to body shaming and things like that. For all teens, fear of missing out is, again, a bullying issue that Instagram has been, it didn't invent bullying. It just gave bullies a really effective tool. And any parent of a teenage kid has at least some exposure to this, either directly or indirectly. The second issue for Instagram is, because it is so dominant among young voters, we would anticipate much more manipulation of voters, attempts to suppress young voters from going out and voting in this election cycle. And I don't think Facebook is prepared for that, and it concerns me enormously.
So do you think this is the beginning of some short or long-term pain? Will we see this again next quarter and the quarter after that, given what Facebook CFO Dave Wehner said on the call, that this revenue deceleration essentially is going to continue?
Well, I believe that relative to the portions of the business that are hurting now, which is basically the Facebook product in North America and Europe, that those issues will persist. And it's now a matter of time to see how long it takes for Instagram, WhatsApp, Marketplace, and the other things that Facebook can monetize from here to fill the hole and restore the growth. I have actually... my sense is that those things can do that. The larger question for investors is what PE multiple we're going to put on this stock, given that we know now that the business model is so dependent on activities that we wouldn't permit in any other sector of the economy. And tech's been given a free ride and been allowed to get away with behaviors that are regulated everywhere else. And until that regulation comes in and makes it safe to be involved, I think these companies are going to carry a stigma, and there will be a huge relative benefit to Google or Twitter or anyone else who can distance themselves from disinformation, can distance themselves from election manipulation, because I do believe Facebook is sincere in its efforts to try to limit that kind of stuff. I don't think, however, that the things they're doing are going to be effective, because the problems are at the heart of the business model. They're not things that can be fixed by adding 20,000 moderators.
That was early Facebook investor Roger McNamee. Still ahead, we will stay on the earnings front. Later this hour, we will also talk about Qualcomm terminating its deal to acquire NXP, bringing an end to a nearly 2-year saga. We'll talk about where the chip maker, both of them, go from here. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. President Trump took aim at two familiar targets in the United States again this week, Amazon and the Washington Post. Both are controlled by the richest person in the world, and that is Jeff Bezos. On Monday, the president called the Washington Post an expensive lobbyist for Amazon. Trump also alleged that the retailer has a huge antitrust problem. Staying on Amazon, the company came out with its earnings Thursday. We caught up with Boomerang CEO and former Amazon exec Guru Hariharan, as well as Jitendra Wawal of Bloomberg Intelligence to break down the results.
If you actually look at the profit beat, was massive by every standard. If you look at every segment, AWS, North America retail, international retail, margins improved across the board. And one of the key things that jumped out was, if you look at the advertising revenues, you know, that last quarter they started reporting it under the other with the new accounting change, continues to be strong, 130% growth in that segment. So a combination of these advertising plus the fulfillment by Amazon program picking up and private label goods, these are helping margins, and that's driving this monster beat on earnings.
The CFO on the call talked about how the company is improving efficiency basically across the board, even as they're making these big investments, Guru, in Alexa, in grocery, in prescription drugs.
Yeah, so right now Amazon's achieving a big snowball effect. They're starting to build some big momentum. But if they look forward, there are about 3 plays that they have to really perfect. Number one is like a very defense play that they have to play in the cloud services businesses. There's competitors coming in, like Microsoft is making a big acquisition and closing up with developers by acquiring GitHub, and then Google going big on their cloud businesses. So they have to play defense over there. But there are 2 other areas where they can play massive offense and gain a lot of revenue and margins. Number one is, as Jitendra said, AMS, Amazon Marketing Services. And that's a very high profile and a high margin business for Amazon. It's growing very rapidly, as it's a very measurable technique for consumer packaged goods to start getting in front of shoppers. The other is the grocery business, which, having acquired Whole Foods, and that's starting to pick up momentum, and they're integrating those 2 businesses, as we saw, and even in Prime Day, that's a very big $800 billion opportunity, a revenue opportunity for Amazon to capture.
Also, Amazon saying on the call that Whole Foods is driving new Prime memberships, and that on Prime Day they saw more new subscriptions than ever, despite that big glitch. Jitendra?
Yeah, I think the pace is accelerating at a smaller than expected pace, to be honest. But like Harry said, it's actually a very a big market and very low penetration right now. So the opportunity is there. They just have to build the infrastructure around it first.
Guru, are there any red flags?
I don't see many red flags at this point. Even the slower revenue growth is just it could be a strategy in terms of starting to capitalize on some of the profitability levers that Amazon is starting to create because of the Prime membership and because of their ability to capture a lot of customers in a very sticky way and all that. And that allows them to start reinvesting all that back into R&D. And we saw that the R&D expense again went up pretty significantly. And that just allows Amazon to create a very significant competitive moat in the long run.
So, Jitendra, would you agree? Do you not see as many challenges ahead?
Well, we talk about tax challenges, we talk about regulatory challenges, you know, the overarching ones. But
and
when it comes to the business,
this is the quarter in which President Trump has taken aim at Amazon, for sure.
Absolutely. But if you look at the core business, especially the marketing services business, I mean, what we are seeing is Google and Facebook go after the traditional digital advertising dollars, right? But Amazon can actually go after both. They can go after the retail traditional digital advertising dollars, but they also can go on the trade promotions bucket. So basically, they can grow without actually directly competing with Google and Facebook in a lot of ways. And if you look at their traffic on their platforms in the US, they're getting pretty close to where Google and Facebook are. So they have the ad inventory, and we have seen Alibaba do this successfully in China. So we see, rapid growth coming in profits from advertising.
What about international, Guru? They talked about improving efficiency in Europe, in Japan, as they continue to invest heavily in India.
India is a big growth segment for them. And we also saw that the head of India is now the part of the senior team at Amazon. With having missed the boat in China, they're very serious about India. Developing country, they also announced a big entry into Australia. They had some bumps in the road with that, but there's a big market to be had over there. Europe continues to be very strong for them, but a lot more developed than the other countries. But all these vehicles that we're talking about in terms of whether it be advertising, whether it be Prime, Subscribe and Save, and consumer packaged goods and grocery, these are all significant amount of opportunities, not just US, but international.
That was Boomerang CEO Guru Hariharan and Jitendra Rawal of Bloomberg Intelligence. Coming up, Alphabet hits a home run in its second quarter, with Google bringing in marketing dollars despite costly regulatory trouble in Europe. We'll talk about the consumer impact of the EU's action against Google next. And later this hour, President Trump tweets that tariffs are, quote, the greatest. Meantime, dozens of business leaders travel to Washington to argue the policy is cutting into profits and forcing them to raise prices. This is Bloomberg. SpaceX launched a batch of satellites for longtime customer Iridium Communications early on Wednesday. The Falcon 9 rocket lifted off from Vandenberg Air Force Base on the central California coast. This was the 14th mission of the year for the company, run by billionaire Elon Musk. SpaceX is hoping to launch at least 30 rockets in 2018. Executives at Google are giving no sign that a costly regulatory crackdown in Europe will hurt sales and profit anytime soon. Parent company Alphabet posted second quarter results that smashed Wall Street expectations Monday. On the earnings call, CEO Sundar Pichai suggested the company wouldn't dramatically alter its Android strategy.
We will always take a constructive approach. We'll appeal the Commission's decision and take the due process available to us. But we're also looking forward to finding a solution, above all, that preserves the enormous benefits of Android to users and so on. So there is more work to be done, and I think it'll become clear as we go along. But I'm confident that we can find a way to make sure Android is available at scale to users everywhere.
So what does this mean for regulation of the tech industry as a whole? We spoke with Bloomberg's Caroline Hyde in London, as well as Shira Ovide of Bloomberg Opinion in New York.
The fine from the EU, the $5 billion fine, was just a week ago. And as I noted this morning, it was literally a footnote in my column yesterday. That's how relatively immaterial it was to the results of the company, at least financially. So that's a pretty interesting thing to note. And the other thing is that the issue that had been freaking out Alphabet investors for the last few months was its spending, particularly these payments that it makes, revenue sharing payments to its partners like Apple and others. And the pace of growth of those payments moderated in the second quarter is the way they put it. And again, that gave investors in Alphabet some relief, although we'll see how long that relief lasts.
Now, Caroline, Google's appealing this ruling, but it hasn't been appealed yet, and they still face this $5 billion fine, which they will accrue over the second quarter. And the bigger question is, will handset makers now start charging Google to pre-install these apps that are in contention? Are investors correct in shrugging off these regulatory concerns?
Yeah, I think that's the key question. I mean, Mark Mahaney, you talked to him a lot at RBC, is saying, look, actually the size of the fine was the great unknown, and maybe the key regulatory issues are in the back mirror. Yes, AdSense is still being investigated by the EU, but $5 billion, put that to one side. I think it's interesting as to whether or not we will see Alphabet's Google having to start to bid for the real estate that it might have to forego if they don't manage to appeal successfully. Remember, they got about just over 2 months to put in their appeal to the EU. If they do indeed have to change their business model, if they can't just automatically put Google Search and Google Chrome into Android devices, maybe they'll have to start to bid to win that sort of real estate against other app makers. But as many have been noting, particularly Nate Langston over here, a tech reporter for Bloomberg, has been saying, look, they've still got the deepest pockets around. I mean, as Shira was saying, look, $3 billion is net income what they managed to make despite a $5 billion fine. So overall, this is a company that can still splash the cash to ensure that Google Search is where it needs to be and therefore draw in the key advertisers.
Now, Shira, earlier in the show, we spoke to Bill Smead, an investor who's warning that participating in this tech euphoria is incredibly dangerous and will permanently damage long-term investor success. This, as Google reports, 25+% revenue growth. What about the bears here? Does he have an argument?
I think he does. And look, it depends a little bit on the company. There's a pretty big difference in the euphoria, quote unquote, between a company like Netflix or Amazon, whose stock prices have just grown by leaps and bounds, are trading at valuation multiples that are not normal, and then a company like Facebook or Google or Apple, which are trading at relatively modest valuation multiples for companies of their size and growth rates and profits. So that's a little bit of the difficulty of making kind of broad brush arguments about big tech, that there's a pretty big distinction between the maybe unsustainable valuations of companies like Netflix and Amazon and the valuations of companies like Alphabet and Apple.
Now, Caroline, what's interesting is that these tougher EU privacy laws have so far, it seems, helped rather than hurt Google. In fact, they've actually hurt smaller players that have had trouble becoming GDPR compliant. I asked Alphabet CFO Ruth Porat about this in a phone call before the conference call, and she said, it's still too early to tell what the real impact of GDPR will be. But, from the outside, from your perch, what does it appear, how does it appear these new regulations will actually impact these companies one way or another?
Well, this seems to be the effect that maybe the EU didn't realize it was going to have when it brought in these tougher privacy laws, when it made sure that key companies, when they do specific advertising, that they get my agreement that I'm allowed to be targeted in such a way. Well, suddenly the unknown consequence of this is it reinforces the duopoly, such as Facebook and Google, because they were compliant. They had the cash ready to be able to invest, to make sure ahead of the game they were asking their user base if they did indeed want to receive such targeted ads. They therefore have the trust of those who are looking to buy advertising that they can target and be compliant with GDPR. So therefore, the companies that are looking to advertise are going through Google's own services rather than rivals because they trust them and they ensure that they're not going to get any fines coming from the EU. So thus far, it looks as though actually it's benefited Google's bottom line GDPR compliance rather than in any way undermined their control of the market, which of course is exactly what the EU generally wants to do. It doesn't want to reinforce duopolies. It tends to want to ensure that competition is wide and varied.
Bloomberg's Caroline Hyde in London and Shira Ovide in New York. Coming up, we'll turn to the chip makers. Qualcomm scraps its plans to buy rival NXP amid U.S.-China trade tensions. What it means for deal making ahead. And Bloomberg Tech is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Emily Chang. There are bigger forces at play here than just us. That is what Qualcomm CEO Steve Mollenkopf said after announcing he's abandoning his $44 billion bid to acquire rival NXP in what would have been the largest ever deal in the chip industry. The aborted takeover may be the highest profile victim yet of the trade spat between China and the United States, with every other relevant jurisdiction in the world clearing the bid months ago. While China denied its decision had anything to do with trade tensions, Qualcomm CEO Steve Mollenkopf seemed to disagree.
The decision for us to move forward without NXP was a difficult one. Continued uncertainty overhanging such a large acquisition introduces heightened risk. We weighed that risk against the likelihood of a change in the current geopolitical environment, which we didn't believe was a high probability outcome in the near future.
The news came as Qualcomm released earnings Wednesday. The company also outlined its plan to buy back nearly $30 billion or so of its shares. We were joined by Romain Bostic, editor of the Top Live blog for Bloomberg News, and in Washington we had Isaac Stonefish, a senior fellow at the Asia Society.
Qualcomm had banked a lot of its future on a merger with NXP, and now that that's not happening, there's going to be some questions, I think, long term about what the future of Qualcomm is and how it's going to be able to grow. Of course, as you mentioned, it did sort of cushion the blow today with that stock buyback announcement, but that probably will only sort of give a temporary boost to the stock until we get a little bit more clarity from management on what they can do. As far as NXP, I mean, it's a little bit more murky because no one's quite sure exactly what options they have other than going it alone, particularly in the environment that we're in. So unless some of the rhetoric here on the U.S. side between the U.S. and China changes in the next few months, I think that both companies are going to sort of have to go on sort of solo paths, if you will.
NXP certainly has a tough job ahead convincing investors it has a strong future as an independent company. Qualcomm CEO Steve Mollenkopf said today, we didn't see an end to the process or near end to the process, so we had to move on. There were probably bigger forces at play here than just us. We are still big fans of the deal, and the logic behind it. So, Isaac, he's certainly there implying that the trade tensions between the U.S. and China had something to do with this. Chinese regulators, as far as Bloomberg has been reporting, were on track to approve this deal, but did not. They didn't say no either. What should we read into it?
The CEO did say, I think roughly a week ago in the New York Times, that, yeah, I think trade tensions have something to do with this deal being held up. And I got to say, this is a very classic Beijing strategy. They didn't deny the deal. They didn't block it. No official statement saying that this deal is not going to go forward. They just let the deadline expire. I guess we're, 6.5 hours away from the deadline. And they just said, okay, we're just going to let this one go. And it gives them plausible or somewhat plausible deniability when they're having this conversation. They could say, oh, yeah, we didn't have enough information from Qualcomm. We didn't have this. We didn't have that. This is not part of the trade tensions. And if they do make that point with the U.S. side, it allows them to say, listen, we're blameless on this. You guys have to make other concessions.
Romain, how big a shadow does this cast over potential deals in the chip industry? This after, President Trump essentially blocked that acquisition of Qualcomm by Broadcom.
Yeah, I mean, there's a pretty clear message, I think, coming out of the administration here that really any sort of mergers, particularly cross-border mergers, are going to be scrutinized not in the context of whether it's good business, but really in the context of the trade war and whether it's good politics. You saw some of the comments from Qualcomm today sort of alluding to that, and for the reason that they wanted to walk away. I think it's going to give a lot of companies pause going forward, because you're not really navigating sort of antitrust issues and some of the more traditional issues you would have to deal with regulators. This is really about how does your merger fit into sort of the new policy initiatives by the United States government, and does it conflict with what they're trying to do and exerting their influence over their trading partners.
Now, the blocking of that Broadcom-Qualcomm deal is something that Qualcomm wanted, but Isaac has, President Trump inadvertently hurt an American company, Qualcomm, as a result of this quote-unquote America First strategy.
It certainly wouldn't be the first time. I think there's a lot of frustration among American companies about the way that trade tensions are going and about tariffs on Chinese goods. It slows down their business and makes it harder for them to deliver products to their consumers. And American companies do not have the same obsession with the trade imbalance that Trump does. Trump, Navarro, other people at the top of his administration feel really strongly about rectifying a trade imbalance, but most of the serious economists out there and business people out there don't feel that that's the problem in terms of doing business with China. They're a lot more interested in intellectual property issues and market access issues. They don't really care about the trade imbalance.
Now, Qualcomm, Romaine, has some other big problems. I mean, its stock is on its way to its third year of annual declines, and also it's in this big standoff with Apple in various disputes around the world.
Yeah, that's sort of getting overshadowed. I mean, the stock's down about 8% this year before today. You consider that the rest of the semiconductor space was up about 9% so far this year. So it's really lagged, and that's really because of the fundamental issues that are still plaguing this company, something that, frankly, I don't think I saw a lot of discussion about out of the release. They're getting some questions about that on the call, but this is something that I think once the sort of the euphoria over the buyback dies down, investors are going to have to reassess. Is the growth still there, the organic growth still there for this company? Can they resolve some of the issues that they're having with Apple? Right now, those questions are still out there.
Thanks to Bloomberg's Romaine Bostick and Isaac Stonefish of the Asia Society. Global trade also dominated much of the headlines this week as the world reacts to President Trump's tariffs. Tuesday, the president tweeted, "Tariffs are the greatest. Either a country which has treated the United States unfairly on trade negotiates a fair deal, or it gets hit with tariffs. Simple as that. And everybody's talking. Remember, we are the piggy bank that's being robbed. All will be great." But not everyone agrees with the president, including the semiconductor industry. SIA, an association which represents the likes of Qualcomm and Intel, submitted comments to the U.S. Trade Representative's public hearing Tuesday that Trump's tariffs will, quote, undermine U.S. technological leadership, cost jobs, and adversely impact U.S. consumers of semiconductor products and the U.S. semiconductor producers. We broke it all down with Bloomberg's chief content officer, Marty Schenker, and visiting San Francisco from Tokyo, Bloomberg's Asia Tech managing editor, Peter Elstrom.
The technology industry is nervous about this because the supply chain for tech stretches between the United States and China in particular, especially for the chips companies. They're shipping a lot of product into China. Those are being assembled into finished products and then shipped back across the ocean. So they're kind of straddling this industry on both sides of the ocean. They're nervous that if this trade war gets out of control, it's going to cost them business. It could raise prices. It could cause other kinds of disruptions to the supply chain that's so essential to their business.
Meantime, Marty, we've got new news that the Trump administration plans to attempt to shield farmers from the impact of this trade war. Of course, we can assume farmers are a larger part of his voting base, but walk us through the conflicting issues at play.
Well, certainly Donald Trump thinks that tariffs are a great strategy to try to repair the damage of 3 or 4 decades of globalization. And there's a lot of people upset about it. It is true that he is going to try and shield some of the farmers from the damage, and he's asking for patience. Obviously, the semiconductor industry is not a hotbed of Trump support, so I doubt if you'll see some aid to the semiconductor makers or tech in general. But this does speak to Donald Trump's real view that tariffs are the way to go to get people to come to the table and strike better deals.
So far, Peter, the tariffs have been limited, $34 billion worth of imported products. They're talking about another $16 billion more today. And the president has said he's willing to go the whole hog, all $500 billion worth of products coming from China. What are the broader implications here?
Well, it would be a big issue for tech and obviously well beyond tech at that point, too. At the current level of tariffs, it's kind of an opening skirmish. But if you're talking about tariffs on $500 billion worth of products, that's everything that comes out of China into the U.S. That includes Apple's iPhones in particular. Remember, Apple's iPhones are designed in California, but then assembled in mainland China and shipped over here. So if they were to levy tariffs on those kinds of products that would cause damage on both sides.
And Marty, you know, it sounds like he's not just talking about China. When you look at his tweets today, he's talking about any country. I mean, what are the broader implications of this? Could this expand?
It very well could expand. Of course, we have Juncker from Europe coming tomorrow to talk to Donald Trump and try to defuse the situation. Watch for the results of those discussions for a clue about what's going to happen going forward. The longer term issues, as Peter explained, is the supply chain issues. If you're a company, you have to think about whether you need to permanently disrupt your supply chain plans if this becomes a protracted trade war.
And several companies have said that they might be forced to move outside the United States. Kimball Electronics, which is based in Indiana, just said so more recently. Peter, you're based in Tokyo. What is the view on this in Tokyo, in China, you know, from the Chinese government?
I think generally they're nervous that this could disrupt a business process that's been very successful with them. China, of course, has grown into the manufacturing hub for so much of the technology industry, for so many more things beyond that, including apparel and automobiles.
Successful for them, but what about for the United States, which is exactly Trump's argument?
That is what Trump is calling them out on at this point, but they're nervous that this could go south.
So how could they retaliate? I mean, we've already seen some retaliatory measures, but we also haven't seen them go the whole hog either.
Yeah, the disconnect is that they can impose tariffs on goods coming out of the U.S., but it's not nearly as much. They, of course, have many other points of leverage, though. Take Apple, for an example. China is a very important market for Apple. It's the second largest market for them. They need to be able to sell their phones there. They've lost some ground against domestic competitors. They also run the Apple stores within China. That could be a point of contention. And then you have many other companies that are depending on China for growth and opportunities, from Starbucks to IBM to Apple, as we mentioned.
Marty, you know, obviously this is a very unpredictable administration, but is there any sense of which direction this is going to go in? Is it going to get worse before it gets better? If it ever gets better, are we at risk of that? Or, you know, is China at risk of those $500 billion of goods ultimately being taxed?
Well, I do think that ultimately Donald Trump likes to rescue situations he sets up himself. And so I've contended that at the last minute there may be some conversations on a personal level between Trump and world leaders, Xi in China, for instance, to try and resolve this situation. But I think it's going to get worse before it gets better, and it'll have to be the markets themselves and the economy that'll force these issues onto the table.
Thanks to Bloomberg's Marty Schenker and Peter Elstrom. Well, the battle to be China's premier meal delivery service is heating up. Alibaba's platform, Ele.me, will spend $443 million trying to win over customers from rival Meituan. Ele.me's goal is to control over half of the Chinese food delivery market. Meituan currently has a 59% market share. Ele.me, valued at nearly $10 billion, is said to be seeking at least $2 billion in funding to bankroll this battle with Meituan, which is considered the world's third biggest startup. Meituan is said to be planning an IPO this year, targeting a $60 billion valuation. Still ahead, Spotify successfully fends off the competition for now. How the music streaming company is keeping Apple and Amazon at bay. This is Bloomberg. Airbnb received one of the biggest blows in its 10-year history last week. New York City Council voted to require the company to hand over the names and addresses of its hosts in the city. According to officials, this information is needed to police Airbnb hosts that may be driving up neighborhood rents. Sources say this legislation could potentially cut Airbnb's New York City bookings in half, raising questions about Airbnb's growth as cities crack down on restrictions. Airbnb has said the bill is in violation of user privacy as it prepares for its $140 million in gross bookings to drop by at least half when the legislation goes into effect in January. And Spotify seems to be overcoming its Apple threat. The newly public company was out with earnings Thursday, and it gained more subscribers than expected thanks to customers in Latin America and emerging markets. This eased investor concerns that competition from Apple and Amazon will stunt growth. Spotify boosted its customer base to 180 million in the second quarter, more than the average 178.5 million forecast by analysts. Paid subscribers hit 83 million. That's more than any other music service. We caught up with Spotify analyst Justin Patterson at Raymond James on Thursday.
Still in the early phase of secular growth of streaming music. You've got a lot of devices like the Amazon Echo, the Google Home proliferating right now, and subscription has really gained more awareness with customers. So it's very early innings. People are shifting from a traditional purchase model to a rental model, and there's a lot of growth across the globe at this point in time. And Spotify is one of the beneficiaries.
We talk a lot about the subscription service, but that ad-supported free service is also a big driver. How big?
You know, it varies from company to company. For Spotify, it's a very small bet today. It's about 10% of revenue. They actually missed a little bit this quarter due to some GDPR-related issues. But longer term, radio is a $25 billion market globally. There's a lot of room for Spotify to grow that.
Talk about the competition with Apple, and we're still waiting for Apple to report, but this is a company that obviously has really deep pockets and really long-term relationships with artists that Spotify has to compete with.
Right, it's a great question. Apple does have a platform advantage. It can push Apple Music out to all of the iPhone owners, the iPad owners in the market. That said, if you look at the global market, Apple really has a small market share relative to Android, relative to other devices, and that market share further fragments when you factor in that Amazon Echo is the dominant speaker. So when you look at what's going to be the winning factor for a streaming business, it's device ubiquity. Spotify's a Switzerland, it works on every device, and it's starting to build up this data advantage that I think is going to be really difficult for others to compete with.
But Amazon also has its own music service that it's trying to
It does.
push on users.
It does. They're all trying to push you. It's kind of a unique situation where Amazon, Google, and Apple are your competitive set. Yet Spotify right now is the market share leader. And if I look at each one of those businesses, they do one device well, but not every device well. And none of them are really optimized to work on one another's devices. Spotify works great across every device in the marketplace, and that's one of the reasons it's been growing so rapidly.
Talk to me about the data that Spotify has and why it's so valuable.
Yeah, it's another really great question. So if I look at the way artists are compensated these days, it's more toward live performances and building up an audience. So what Spotify is doing with the Spotify for Artists initiative is bringing that data back to musicians, helping them grow their audiences. In this past quarter, I think Spotify increased audience listenership by about 5% for independent artists. That's something that can really start to build up over time and monetize, help artists be more successful.
So how does that differ from what Apple does and Amazon and Pandora?
I'd think of it really as being that data advantage is basically a function of Spotify's scale. With 180 million users around the globe, Spotify is multiples bigger than any other player in the market. And with that, it just consumes substantially more hours listened. Apple is still a subset of the market. Pandora only looks at the US. So if you're being a global player, trying to build a global audience, you need Spotify's data.
What are the trends we should be watching for in emerging markets and international markets?
Yeah, for the emerging markets, I think it's really just a function of market launches at this point in time. Spotify's mostly in developed markets right now. It was in 65 markets at the end of this past quarter. It's starting to launch in the rest of the world a little bit more. It did its first launch in Africa last quarter. So I'd really be watching just what exactly are the app download trends for Spotify. Is it getting partners to help push the device, push the application in those markets? And then what exactly is the price point? Because if you do go into the rest of the world, discretionary income gets a little bit less, so you need to price it accordingly for different markets.
That was Justin Patterson of Raymond James. Coming up, we will hear from Bloom Energy CEO as the company hits the public market with shares spiking over 60% in its first day of trading. Why it is so rare for alternative energy companies to go public. Next, this is Bloomberg. Bloomberg has learned the Trump administration will try to revoke California's authority to regulate car emissions, including its mandate for electric car sales. The proposed revision of Obama-era standards is expected to be released this week. The revamp would also put the brakes on federal rules to boost fuel efficiency into the next decade and instead would cap federal fuel economy requirements at the 2020 level. Well, Manhattan office buildings and sprawling data centers can now get power without connecting to a utility grid. Bloom Energy is helping make it happen. And this $270 million IPO means more cash to fund expansions. It's the first alternative energy IPO in the U.S. since October 2016 and the best first-day debut of the last 5 years. Shares were up over 66% in its first day of trading. Our Bloomberg News Deals and IPO reporter Alex Barinka reports.
Imagine a future where anyone can be their own power provider. That's the reality that Bloom Energy CEO KR Sridhar set out 16 years ago to create. Now, he's selling that story to public market investors. Bloom Energy just began trading on the New York Stock Exchange Wednesday morning.
We have a very simple value proposition. Number one, we are more reliable and resilient than the grid. Number two, we are cleaner than the grid. Number three, we save them money.
Bloom sells what it calls energy servers. They're customizable systems that generate power for customers like Morgan Stanley and AT&T without the need to connect to a power plant. These high-tech boxes run on natural gas or biogas 24 hours a day, 7 days a week. In the past 5 years, only 1% of American IPOs have been alternative energy companies, and it's been a year and a half since the last one went public. Clean tech had been riding a popularity high on the tail of the more than $100 billion the Obama administration piled into the industry. Under the Trump administration, enthusiasm for the space has faded, along with many of the government tax credits and other incentives for clean tech. Yet the reinstatement of an investment tax credit for fuel cells in the massive tax overhaul bill worked in Bloom Energy's favor. The cost of fuel cell projects has also declined as the systems have become more efficient. For years, Bloom had been racking up a huge deficit totaling $2.3 billion, but the company's financials are finally turning a corner. In the first 3 months of this year, revenue quadrupled compared to the same period in 2017 to $121 million.
The world needs reliable electricity. We've gone from a mechanical age to a digital age, and we are a solution.
An alternative energy company that's inching closer to profitability is a reality that public investors can get comfortable with.
With us now, Bloomberg's Alex Barinka with more on Bloom Energy's IPO. What makes it so unique among other such companies that have had difficulties going public?
It's a fuel cell company. So when you think of alternative energy, you think solar. And solar's been kind of the reason the whole industry's been dragged down. China's the biggest market for solar, and they ended their initiative in May. That's brought down the whole group. Fuel cells are a bit unique. It's not the same thing. They're complicated to put together. You saw those big boxes there. But as you heard KR Sridhar say, the CEO, it does help with costs once customers do get them installed. So there's been this gap because the industry is down at a lull. Folks may hope now that others might follow suit.
Right, so will there be more?
Hopefully, that is the hope here. The issue is Trump seems to be talking a lot about coal. This investment tax credit that they have got reinstated for fuel cells was a bit of a luck in lobbying on Bloom's part. So we will see if we get more out of this part of the clean tech space finally listing.
Thanks to Bloomberg's Alex Barinka there. And that does it for this edition of the Best of Bloomberg Technology. We will bring you all the latest in tech throughout the week. As always, tune in Tuesday for full coverage of Apple earnings and Wednesday for Tesla. Each day, we're here 5 p.m. in New York, 2 p.m. in San Francisco. And remember, all episodes of Bloomberg Tech are now live streaming on Twitter. Check us out at Technology weekdays. That's all for now. This is Bloomberg.